Back to Jamie Dimon. He's setting the stage for the problems of 2008 and how to move forward.
Now we all remember why we had 80% loan to value. There was a reason, and bad losses of 90% and 100% loan to value were hidden by the fact that home prices have been going up for so long. Mortgage securitization had flaws. There's a legitimate complaint that from originator to packager to seller, no one was really responsible for the underwriting from beginning to end. Legitimate complaint helped fuel some of this problem. A lot of speculation. The speculation was on the part of consumers and brokers. And if I had to point out my biggest mistake, probably my whole career, was not closing down our mortgage broker business sooner. Okay? It's a brokered product where it's not our own salesperson in front of the client, has 2 or 3 times the loss rates of all other product. There was excessive leverage everywhere in the system. I'm just going to mention a few. I already mentioned, investment banks. I'm going to give you some more detail on that later. European banks, some insurance companies, but hedge funds were leveraged up, private equity funds, and you remember the LBO markets. Banks added leverage through SIVs, non-banks, mortgage players leveraged up, CDOs leveraged up, commercial and consumer finance players leveraged up, even some pension plans and universities in funny, different kind of ways. They made a lot of forward commitments, which they now have to meet. But that is a form of leverage in the system. And here is a major one. There's a large, I call it a structural flaw, but think of it as a difference. There were some structural flaws that had grown up over time that actually changed why we had a little bit of a crisis time. It's not like we had last time. No one saw the damage they could do. We had a run on the bank. We did not have a run on the traditional bank. A lot of structures allowed short-term financing of liquid assets. SIVs did it, some money market funds did it, some CDOs did it, some hedge funds did it. Money markets had a structural flaw, and I'm not sure it was that important if a money fund broke the buck, but money funds had grown to be $3.5 trillion when people got scared. Within 2 weeks after Lehman Brothers, they pulled $500 billion out of money funds. And I'm going to mention why that's so important. Other financing got very loose in I call it the piping of the financial system, but securities lending, repo markets, and financing markets where people were lending too much money, and they were lending money on non-normal collateral. And then investors, I want to make this just interactive for 1 second. How many of you, either representing yourselves or an institution or a corporation or a university, took money and moved it from something more aggressive to less aggressive or to something more conservative? Raise your hands real quick. Okay, so when people say what caused the crisis, you did. And I'm being completely honest about it. Individuals acting wisely, and we were all acting wisely, this wasn't malfeasance, said, I want to be more careful. I don't want a money fund that breaks the buck. I'm taking money out of a bond fund. I'm taking money out of a high-yield fund or a loan fund. Those funds were direct lenders to the marketplace. They were the other 40% that the banks no longer do. That's what happened. And we have to fix that going forward. That was not malfeasance. That was just our system had changed dramatically over time, and we missed that there could be such a run on a bank and the money funds and bond funds like that. I'm also going to talk about regulatory lapses and mistakes. I'm going to do this very, very carefully because we are heavily regulated. So let me read this, okay? For all of the benefits derived from good regulations, mistakes were made. We do not blame the regulators for what happened. Blame should always go to the specific CEO and the companies for their actions. Just because regulators let you do something does not mean you should have done it. I want to be clear about that. So in the press, if you repeat any of this, make sure you say I'm not blaming the regulators. Good regulation, but good regulation could have helped us avoid a lot of problems. The mortgage business was not regulated for the most part. Option arms, for the most part, took place in non-OCC regulated banks. I can go on, but I will tell you that bad regulation drives out good. We didn't regulate the mortgage business. Basel II, which was adopted not by U.S. banks, but by European banks and U.S. investment banks, allowed far too much leverage. And everyone who had Basel II leveraged to the hilt. And it didn't even include liquidity in how Basel II was calculated. Perhaps the largest regulatory failure of all time was the enormous growth, leverage, and collapse of Fannie Mae and Freddie Mac. It would have been devastating to this country if the country didn't do what it did. And I'm still shocked that we allow this thing called an implicit guarantee. It's not right. It shouldn't have happened. It shouldn't have grown. We're going to have to fix that. We all know there are too many regulators. I'm not blaming them again. And they also have overlapping responsibilities, which sometimes causes a diffusion of responsibility, and they have inadequate authorities. I've seen several regulators talking about that they didn't have the ability to do certain things, and they did not. They could not have taken over Bear Stearns or Lehman like the FDIC can take over a bank. The FDIC today can take over the banking part of a failing institution, but not necessarily all the global subsidiaries. So our regulators do need more authority to deal with some of these issues over time. And virtually every policy we deal with, in fact, I can't think of a single one which is not pro-cyclical. Loan loss reserve accounting is pro-cyclical. Mark-to-market accounting, which I'm not against, but I'll talk about in a second, is pro-cyclical. Basel II is pro-cyclical. A lot of risk management tools are pro-cyclical. The rating agency's behavior is highly pro-cyclical. And, of course, investors are pro-cyclical. I'm not sure we can ever change that. They want to be more conservative when times are tough. They want more capital ratios and things like that. I also think, and I'm not going to worry about this one too much, I suspect when the real economists write what was at the root cause of all this, I think one of the root causes, and this will be written out for a long time, is our huge trade and global financing imbalances, which fueled very low rates, excess consumption, and over a long period of time. I do not believe you can run those kind of trade deficits and not have a problem. There has been times in history where you have, and they resolve themselves nicely. I don't think you should rely on that as a matter of policy. We created an enormous problem in this country with bad long-term policy. I would put Iraq, energy policy, short selling, getting rid of the uptick rule possibly, and the pressure on hedge funds, corporations, and institutions to perform as adding to this. The government action, you know, I'm one of those who went and agreed to take the money from the government, I guess it was October sometime. We believed then, as we believe now, that accepting the money was the right thing to do for the U.S. financial system. Even if it was not necessarily the right thing to do for JPMorgan Chase, because we did not need the money, we did believe it was a major effort to stabilize the financial system, and we didn't think that JPMorgan should be parochial or partisan and stand in the way of the system. And of course, we would benefit by the health of the system. We think the government acted extremely boldly. I hesitate to think what would have happened had they not done it. Banks are lending more because of TARP. So if you ask any TARP bank, they're lending more than they otherwise would have. I know ourselves, we put the money into the interbank markets, we bought mortgage-backed securities. We're trying to do it in a safe and sound way, and we still believe that the TARP money can help. We did not expect, after we did TARP, that all these other things would be added to it, but we're going to keep our eye on the ball, what's right for J.P. Morgan and what's right for the United States of America, and not overreact to some of the provocations with all the other restrictions that are coming up. We think that the government's also made some other very bold acts.